Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Monday, August the 17th, 2026, and we have a packed show ahead. The biggest week of retail earnings this quarter is here, and the macro calendar is loaded with housing, industrial production, and the Fed minutes. Let's get right into it. Lizzie, we've got Home Depot tomorrow, then TJX and Lowe's on Wednesday, and Walmart closing things out Thursday. What's the single biggest question these reports need to answer?
Morning, Robert. The market needs to know whether the US consumer is genuinely pulling back or just pausing. Because Friday's retail sales dropping 0.6% in July sent a real jolt through sentiment. And these four companies collectively touch almost every income bracket in the country. So their results will either validate the stagflation concern or give the bulls reason to extend what's been a solid 3-week winning streak for the S&P 500.
And that stagflation risk, how serious is it right now, with inflation expectations jumping to 4.3% in the Michigan survey alongside that weak spending number?
It's a genuinely uncomfortable combination. And the reason this week's earnings are so important is that they're the best real-time read we have on whether consumers are actively cutting back or whether July was noise. If Walmart and Home Depot both guide cautiously, that stagflation narrative gets a lot harder to dismiss. And sectors like real estate, banks and consumer discretionary, which are already under pressure from elevated yields, could see meaningful further downside.
Home Depot is first up tomorrow. They barely beat last quarter, and now the bar is $4.73 as in EPS against $47 billion in revenue. What are you watching most closely in that print?
The number I care most about is comparable sales growth, because Home Depot's top line is still heavily tied to housing activity and big-ticket renovation spending. And with housing affordability still stretched, any softness in comps would signal that the rate environment is finally biting the home improvement sector in a meaningful way. A bare beat on EPS won't be enough if management's forward commentary sounds defensive.
And Walmart closes the week Thursday. The stock is already down over 11% since its last earnings, despite beating across the board, and it's trading near 38 times forward earnings. Does it need a beat and raise just to hold its ground?
Essentially, yes, because at that valuation premium, the market is pricing in execution, not just adequacy, and Walmart has actually been getting modest negative earnings revisions heading into this print, so investors are already a little cautious. The one edge Walmart has is that a stagflation environment historically benefits value-oriented grocers as consumers trade down, but the stock still needs EPS of around $0.74 on roughly $186.9 billion in revenue, plus raise guidance to justify where it's sitting.
Before we get to Steve, a quick one. Reddit joins the S&P 500 tomorrow and already surged over 12%. Is there still a trade there, and where does the S&P 500 itself stand technically heading into all of this?
The mechanical index fund buying is largely priced in at this point. When you see a 12% surge ahead of the inclusion date, most of the forced institutional demand gets front-run by traders who anticipated it. So chasing Reddit here carries real mean reversion risk. On the broader S&P 500, the technical picture is neutral right now. The index has been running for 3 weeks and momentum indicators are elevated without generating a fresh directional signal. So if retail earnings disappoint and Wednesday's FOMC minutes read hawkish, there is a credible reversal risk building here that traders should not be complacent about.
Steve, housing starts and industrial production both drop tomorrow. With the consumer already under pressure, what are you watching for there?
Housing starts are the one I'm more focused on, Robert, because the forecast for July is sitting at 135 million annualized units, which would represent a meaningful step down from June's actual reading of 1.47 million. And given where mortgage rates are and the persistent affordability pressure in the housing market, a miss below that forecast would reinforce concerns that the rate-sensitive sectors of the economy are decelerating more sharply than the Fed's current posture accounts for. Industrial production for July is also due tomorrow, though there's no consensus estimate available, so the directional move relative to June will matter more than any specific number. A soft reading there would compound the narrative that both the consumer and the manufacturing side of the economy are losing momentum simultaneously, which is exactly the kind of growth scare that makes the FOMC minutes on Wednesday even more consequential.
And on the labor side, initial claims came in at 209,000 last week, above both the forecast and the prior reading. Thursday, we get the next print with the forecast nudging up to 212,000. Is the labor market quietly softening?
It's a signal worth taking seriously because 209,000 came in above the 202,000 forecast and above the prior week's 200,000. So we've had 2 consecutive weeks of claims drifting higher, and the forecast for Thursday's print is 212,000. If that comes in at or above forecast, we'll have a clear 3-week trend of rising claims that would be difficult to dismiss as seasonal noise, and in the context of that surprise payroll contraction of 23,000 jobs we saw recently, it would add meaningful weight to the argument that the labor market is starting to crack at the edges, even if the headline unemployment rate hasn't moved dramatically yet.
Lizzie, the FOMC minutes drop on Wednesday. What's the market most nervous about seeing in there?
The key fear is that the minutes reveal more hawkish internal debate than the post-meeting statement suggested. Specifically, if multiple Fed members were pushing for a rate hike in July or signalling a low threshold for September action, that could reignite rate hike pricing well above the current 25 to 32% probability. And that would be a significant headwind for equities and crypto simultaneously, especially with Treasury yields already approaching 19-month highs on the 10-year.
Lizzie, let's flip to crypto. Bitcoin is holding just above $63,000, but spot ETFs bled nearly $5 billion in outflows year to date, including $390 million just last week. How do you read that setup?
It's a market that's trying to find a floor but hasn't convinced institutional money to come back yet. Bitcoin is actually flashing a modest buy signal, technically this morning, with a bullish divergence around $63,500 where price is near recent lows. But the relative strength is holding up, suggesting sellers may be losing momentum. But that's a cautious watch signal rather than an aggressive entry, given the Fed holding rates at 3.50 to 3.75%, and the ETF outflow data sending the opposite message about institutional conviction.
Strategy sold Bitcoin below its average cost basis for the first time since 2022. And now MSCI is proposing to remove MSTR from its global indexes. What does that mean for anyone still holding MSTR as a Bitcoin proxy?
It's a compounding risk situation that makes MSTR increasingly difficult to hold as a clean Bitcoin proxy. The MSCI removal proposal, if finalised in November, would force benchmark tracking funds to sell their positions mechanically, regardless of Bitcoin's price direction. And layered on top of that, you have the company's own financials deteriorating, with deeply negative operating margins and a valuation near 66 times forward price to sales. So investors seeking Bitcoin exposure are arguably better served by direct ETF ownership at this point, rather than taking on all of MSTR's idiosyncratic corporate risks.
Ethereum is down 37%, Solana 40% year to date, with major research firms projecting a cycle low between September and November. Is there any credible bull case for altcoins right now?
The honest answer is that it's mostly a waiting game, with a few early-stage signals worth monitoring. Ethereum is technically neutral around $1,194 with no strong directional conviction, and Solana is similarly range-bound near $75.70 with balanced momentum indicators. So neither is setting up a clear entry right now, and the most credible medium-term bull case rests entirely on the Fed pivoting. September rate hike odds have already dropped from 75% to around 32%, following softer inflation and that payroll contraction, and a genuine policy shift would likely bring institutional money back into the space. But until that happens, the macro headwind remains the dominant force, and the September to November cycle low projection deserves serious respect.
That wraps up today's Morning Bell. Remember, this is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.